In 1907, a millionaire named F. Augustus Heinz moved to New York City intent on getting into the world of finance. He had recently sold his mining company to a competitor the year before and sought to use his newfound fortune to become a major player on Wall Street. He even set up shop at 42 Broadway, located right around the corner from the New York Stock Exchange. Heinz quickly entered the banking business and became close associates with another banker, Charles Morse. Between the two, they became affiliated with a number of national and state banks, as well as numerous trust companies. Before long, Heinz, his brothers, and Morse hatched a plan that Wall Street bets would be proud of over 100 years later. Their plan was to create an artificial short squeeze with Heinz's former company's stock, United Copper. Believing that a large amount of this stock had been sold short, their idea was to buy up as much of this stock as possible, which would drive the stock price up and force the short sellers to cover their positions at extremely high prices. In the wake of this short squeeze, Heinz and Morse were set to make a fortune. The only problem was that their plan failed in spectacular fashion. In a stock market nowhere near as liquid as today, the short sellers were able to find all the stock they needed to cover their positions at relatively low prices. So, on Wednesday, October 16, 1907, Heinz and Morse suffered catastrophic financial losses. Word spread quickly on Wall Street and beyond, and people who held savings or checking accounts at banks associated with the two men began showing up almost immediately to withdraw their money. This panic spread like wildfire throughout the broader financial system. Heinz and Morse were overnight pariahs on Wall Street, and just 2 days later, word spread that the president of another institution, known as Knickerbocker Trust, I promise I'm not making that name up, was an associate of the two men. This news immediately prompted an equivalent bank run on Knickerbocker. Just 6 days after Heinz and Morse's attempted short squeeze, Knickerbocker Trust suspended all operations. Remember, the run on Knickerbocker was based on the fact that the president of this trust was merely an associate of Morse and Heinz. That's how panicked the public was. Knickerbocker's failure is what triggered complete and utter pandemonium in the financial markets, an event which is now referred to as the financial panic of 1907. J.P. Morgan, whose bank still exists today, eventually stepped in and provided the capital needed to backstop the banks, trusts, and other institutions that needed it, but the damage was already done. The stock market wouldn't recover to its former height until 2 years later. A failed short squeeze by two random men triggered a financial crisis so devastating and so significant that plans for the creation of the Federal Reserve began to be formulated almost immediately. The financial markets of the United States could no longer operate without a regulator that would prevent this kind of crisis from happening in the first place. The United States is far from the only country with a central bank. In reality, almost every country has one. So what does a central bank do? We know the U.S. Fed was created in response to the financial panic of 1907, but how exactly does the Fed prevent that kind of panic from happening? In this video, we're going to take a look at what central banks do and talk about the reasons why they're so vital for not only the financial markets, but also economic growth. Monetary crises are a pretty regular thing without a central monetary authority, and this has been proven time and time again throughout history. Bank runs would prompt larger financial crises, which then caused unnecessary recessions that were not based on fundamental economic factors. Furthermore, as a country's domestic economy became more advanced and interconnected, and as the country began engaging in exporting and importing products or services, it became more and more crucial that the domestic currency remain stable. Governments throughout history have also felt the need to create a central bank so that they knew they would always have a buyer of bonds when the government needed to borrow money. Prior to the Federal Reserve, for example, it wasn't uncommon for private banks or even individuals to be intimately involved in resolving financial or fiscal crises, and the U.S. government has been bailed out to some degree by private banks on numerous occasions. This is exactly what we saw when J.P. Morgan stepped in to save the day in 1907. More than anything else, financial panics that resulted in bank runs were the reason for the creation of the Federal Reserve. Bank runs seem like a ludicrous thing now, but 150 years ago, in a time with extremely limited access to information, a simple rumor could literally bring down a bank. For instance, imagine for a moment that someone told you that your bank was going out of business tomorrow. It's easy to see how a rumor like this could result in thousands of people showing up to a bank, all demanding their money, especially when they didn't have the internet to verify the claim that the bank was in trouble in the first place. Banking is all about confidence, and 150 years ago, there didn't exist the policies, laws, and institutions that protect us today. The Federal Reserve, operating in its capacity as a so-called lender of last resort, bolsters the confidence the public has in banks. Because even if a bank run occurred today, the Federal Reserve is there to supply the bank with access to as much capital as it needs to meet the requests of its customers. Aside from preventing bank runs, what else does the central bank do? Well, one of its most important mandates, and probably the one most of you are familiar with, is the management of inflation, or the prices of goods and services in the economy. It's extremely important for an economy to have price stability to ensure people like you and I continue to spend money instead of saving it. If you didn't know how much your money would be worth tomorrow, you would behave very differently as a consumer than you do now. We've all seen the stories of countries that have undergone hyperinflation, where prices for ordinary goods and services rise hundreds or thousands of percent annually. These crises are caused by a system in which the chief executive controls the central bank and can therefore direct the bank to print money. Imagine, for a moment, if the U.S. president could direct the Federal Reserve to send stimulus checks to every American household. History has taught us that chief executives always abuse this authority, but this is a topic for another video. A central bank manages inflation by controlling the interest rates in the economy. If interest rates stay too low for too long during an economic boom, this creates upward movement in consumer prices, aka inflation, because consumers have more discretionary income at their disposal and will therefore demand more goods and services than can be supplied. So it's important that the central bank functions as a regulator for economic growth, lowering interest rates when times are bad, which makes loans cheaper and therefore causes more loans to be taken out, and raising interest rates when an economy is expanding too quickly. The Fed targets an inflation rate of about 2%, meaning they want to see prices rise by 2% per year. So how, specifically, do central banks change interest rates? Well, the U.S. Fed does this through what are called open market operations, which is just a fancy way of saying buying and selling treasury bonds literally in the open market. There really is nothing special about their approach to buying and selling bonds or other securities. The Fed is a market participant, just like you and I. If the Fed wants to lower interest rates to spur economic growth, it can simply purchase treasury bonds, which injects cash into the banking system. The bank then has this extra cash on hand that it can dole out in loans. And all else equal, more cash in the system makes cash what we refer to as cheaper. For example, a bank is going to be more likely to loan out $1,000 at a 1% interest rate if it had $1 billion on hand versus if it only had $1,000. So the scarcity of loanable cash is mostly equivalent to the interest rate on loans. The final role of central banks we'll discuss in this video is to act as a regulator for the banks. One example of this regulatory authority exercised by the Federal Reserve is through the setting of what are known as reserve requirements on all banks in the United States. The reserve requirement stipulates how much of their customers' cash the banks must keep on hand, and therefore also dictates how much of it they can loan out to others. Beyond reserve requirements, generally speaking, the Federal Reserve ensures that no private bank is conducting business recklessly. The Fed has broad authority to regulate banks because, as mentioned earlier, confidence in the banking system among consumers is everything. It must prevent any one bank from breaking the public's trust in that system. In conclusion, a central bank's role varies from country to country, and no two are exactly the same in terms of what their roles are or their administrative structure. Each has its own unique aspects, especially those controlled by the chief executive, which always makes for an interesting story. In the end, though, central banks serve a vital function in our society, and it can't be overstated how important they are to promoting economic growth, stabilizing consumer prices, and maintaining public confidence in the banking system. Thanks for watching.